Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in April of 2024 as outlined in red. I'll also talk about two new strategies I'm experimenting with, capital light companies and wide-moat stocks, which is a simple way to ensure that you're only investing in companies with the strongest competitive advantages. We'll also talk about a possible sector rotation strategy. And if you're interested in the dividend growth portfolio on the far left, I've started a completely free Substack featuring that portfolio to see if I like the Substack platform. You can sign up and see which dividend growth stocks we're buying in real time on the first trading day of each week. But let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified, since it only invests in one sector, and tech stocks by their very nature tend to be very volatile. Also, it's our newest portfolio its performance will fluctuate up and down more so than our other portfolios which have a longer track record. Our tech stock portfolio so far has an annualized return of 20.22% versus its benchmark's return of only 13.91%. The portfolio had a huge month in May and continues its momentum in June so far. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2022 and 2023 as outlined in yellow on the left part of this slide. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. And as a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading. They are on beatthestockmarket.com. So here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular so far, so I put it on Substack for free as an experiment to see if I like the Substack platform. So far, Substack is easy to use and is turning out to be more fun than I expected, since it's kind of a social experiment too. You can find the list of dividend growth stocks that we are buying on the first trading day of each week, either on Substack or on my website, beatthestockmarket.com. Now, you can find most of these strategies on my website, beatthestockmarket.com, but if you can't afford it, each week for free I've been detailing the dividend stocks we've been buying in a YouTube video, and then I feature the tech stock portfolio, wide-moat strategy, and capital light strategy in the next week's video, so I'm rotating back and forth so far. Now, I found that Substack has a notes feature, which are free for anyone to read, and I started posting the list of capital light stocks that we bought for our capital light strategy, as well as a list of wide-moat stocks that we bought. If you're interested in that, sign up for free on Substack and feel free to leave me a comment on Substack to let me know to post either the list of capital light stocks we buy each week or the wide-moat stocks we also buy each week as part of our wide-moat strategy. I don't want to make a commitment of posting them each week if there isn't much interest. So far there's a lot of interest, but let me know. If we get enough interest, I might put one or both strategies on Substack or our website once they have a longer track record. So in this green box up here, note that we've added a note that those three strategies are newer, and therefore the average investment has been held for less than a year. This means their annualized return will fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest, as it was started in February of this year. As you can see on this bottom table, the average investment in the capital light strategy has only been held for 63 days and has a return of 8.93%. The annualized return of 64.2% should be taken with a grain of salt. All it means is if a stock's price increases 8.93% every 63 days, you'll get an annual return of 64.2%. Will it continue to do that well? Probably not, but we hope it keeps beating the S&P 500, which is what our goal is, at least with that strategy. So here's a weekly chart of how our weekly investments into our model portfolio of tech stocks has been growing. As of last Friday, we invest $12.50 each week, and we buy 10 different tech stocks on the first trading day of the week in this model portfolio. And the ratings for our stocks change weekly, so the list of stocks we buy each week will fluctuate. Now, the recent volatile ride of the tech portfolio continues. This flat area happened when tariffs were announced, and the sharp recent rise occurred when the 90-day pause of the tariffs was announced. And then this last dip happened when it was announced that large tariffs will be placed on Europe. And now this past week, our tech stocks took off again as the Europe tariffs have been postponed. So here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about the tech stocks we bought last Tuesday because Monday was a holiday. On this slide are our ratings for the top 15 tech stocks as of last Tuesday. I posted these rankings on our website, beatthestockmarket.com. Then we purchased the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, yield, etc. Now, our highest rated tech stocks last week were Adobe, Accenture, Analog Devices, Intuit, ASML, Arista Networks, Motorola Solutions, Apple, Salesforce, and Microsoft. So we bought the first 10. We list the extra ones just for informational purposes in case you want to do some further research on those. So on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating here is comparing these stocks to other stocks, not to other investments like bonds or CDs. This slide shows our best performing stocks in our tech stock portfolio since our last tech stock video, which was 2 weeks ago. The portfolio had a huge comeback after being hit hard in April by the tariff announcements, which is nice to see the good comeback. The best performers the last 2 weeks were Shopify over almost 10%, NXP Semiconductors, Broadcom, good old NVIDIA, Intuit, Taiwan Semi, KLA Corp, Arista Networks, Lam Research, Workday, Applied Materials, and Analog Devices. Now, one reason why tech companies have been outperforming the market for several decades might be because they tend to require a little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, equipment, employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% during the period of 1990 to 2024. The research calculated capital intensity based on 3 formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results because in the study, they ranked and classified companies based on what they call the 45 sectors of the ICB taxonomy, not individual companies. Not only did they only look at those 45 sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over those many years, they ignored that. The authors admitted that the sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company may be capital light while another is capital heavy. But they ignored that too. I'm assuming they did this to save time because otherwise they would have to look at each individual company's factors for each month or week, and then do this for each and every year in the study, which is a lot of work to do when you're looking back over 30 years. So it seems their study could have been or could have had even better results if they dug deeper and looked at companies specifically instead of sectors in general. And we can do this in real time going forward on a weekly basis, and we have been doing this. We look for individual companies that are capital light but also high quality, because I only want to invest in high quality companies. And our capital light rating is based on individual companies, not whole sectors or whole industries. Now on this slide, I have a list of the S&P 500 companies that are capital light, what I consider high quality, and appear to be undervalued using a growth methodology. These are also the capital light stocks we bought last week. So these ratings are as of last Tuesday. Similar to our high yield stock portfolio, we're using two different strategies within this portfolio. Strategy 1 in red, up here in red, emphasizes how undervalued a company is, while strategy 2 in green includes quality as a factor. So strategy 2 is looking at both undervalued and quality. So you will usually see higher quality companies in strategy 2 as compared to strategy 1, and you can see the quality grades over here. It'll be interesting to see which of these two strategies does better in the long run. So far, the portfolio is way ahead of the S&P 500 as we saw earlier in the video, but it's very early in using this strategy. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the three formulas that the authors used in the study. Now let's talk about our wide moat strategy. This is a strategy I started tinkering with behind the scenes in September 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. So first of all, what is a moat? For those of you that don't know, well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. What is a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantages, then it's easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat around the castle is really wide, then it's hard to storm that castle. If the moat is narrower, then it's a bit easier to attack the castle. And if there's no moat at all, then the castle is much easier to attack. So this strategy only invests in the companies with the best or widest competitive advantages, widest moats. Now there are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration, as well as the moat rating. But the moat rating is a kind of a quick shortcut way to invest only in high quality stocks. Now on the next slide, you'll see my ranking for the top 15 companies with wide moats. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into the portfolio. Same with the capital light portfolio. Now, I originally had the strategy in a Fidelity portfolio with a few other strategies, but I quickly learned that having several strategies, more than two, in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 21.7%. Using Excel's rate function, that's an annual return of 49.42. Now, the strategy doesn't result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot. And the performance likely won't stay quite that high because stocks historically average a total return of about 10% a year. Now, Morningstar offers an ETF that only invests in wide moat stocks, so that ETF is a natural benchmark or comparison for this strategy. Its ticker symbol is MOAT. If we'd instead invested in MOAT on the same exact days, we would have received a return of 10.52% with the same holding period. Using Excel's rate function, that's an annual return of 22.7%. So our wide moat strategy so far has more than doubled the return of the Morningstar ETF. The strategy is also beating the S&P 500 by 18 percentage points on an annualized basis. Now let's look at the ranking of our best wide moat strategies as of last week. In other words, the companies with the strongest competitive advantages. The valuation methodology used here is a growth methodology, not a deep value methodology that we sometimes use with our strategies. Now, unlike our dividend growth portfolio where we want lots of diversification since we plan on living off those dividends, for this portfolio we only buy the top 5 stocks each week instead of the top 10, and we don't limit how much any individual stock can be in the portfolio. So this portfolio is less diversified and way more aggressive than our dividend growth stock portfolio. Remember, stocks in any of our strategies may appear on the list one week but not appear in the next week, as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because a stock falls out of the ranking one week rarely means that we plan to sell the stock. Sales tend to be rare. The 5 companies that we bought last week, because remember we only buy the top 5 for this strategy, were Arista Networks, Thermo Fisher, Salesforce, Adobe Systems, and Nike. Now, one advantage of companies with the best moats is if they pay dividends, they are more likely to increase dividends, even during an economic shock, when compared to companies with no moat. Now, on this slide, Morningstar shows their 3 categories of moats. On top, we have the companies with the wide moats, which are considered to be the best moats. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were still able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now, for companies with no moats, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only includes the 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. Now, the Center for Financial Research and Analysis suggests sectors to overweight and sectors to underweight. Currently, they have overweight ratings on the communication services sector, financials sector, and information technology, as you can see in green. They claim that they have a sector rotation model portfolio that tracks only overweight sector recommendations, and the portfolio has a 30-year trading history. Since its inception in 1995, the sector outlook model has had a 63% hit rate. In other words, it beat the S&P 500 63% of the years, and has outperformed the S&P 500 index by 4.4 percentage points on average per year. So, does this mean that they only invest in overweight sectors, or do they just allocate more to those sectors? I haven't found that out yet, but more research is needed. But I thought I'd share this with you now. You might be interested in it. And over here I've got, if you wanted to invest in some of these sectors with ETFs, here's some recommended ETFs I got for you. Now, I noticed that within each sector, the Center for Financial Research and Analysis also has an outlook for each sub-industry. So a sector is composed of sub-industries. For example, even though they have an overweight recommendation on the communications sector, only 30% of the sub-industries within the communications sectors have a positive outlook. In other words, could we possibly do better than the 4 percentage points per year of outperformance if we only invested in those positively rated sub-industries? I don't know. Maybe we'll play with this in the future, but I think this is pretty intriguing. So let's break out one of the sectors on the next slide. So what I'm going to do is show you the sub-industries that are within the communication services sector. And you can see which ones have a positive or a negative outlook. So here we're looking at the 10 sub-industries in the communication sectors. So here's the sub-industries. Remember, the communication sectors currently has an overweight recommendation overall as a sector. But as you can see, the Center for Financial Research and Analysis only awarded 3 of the 10 sub-industries to have a positive outlook. But as I mentioned in the previous slide, could we possibly do better than the 4 percentage points per year of outperformance if we only invested in those sub-industries? So it seems to me what they are doing is, when they say a sector is should have an overweight they're investing in all of the sub-industries in that sector because they usually use ETFs is what they said they usually do. They usually don't do individual stocks. So could we possibly do better if we ignore the ones that are neutral or had no outlook provided or negative? Some are negative, but not in this sector. You might potentially be able to beat their performance by only investing in these three sub-industries. So let's take a look at those three sub-industries on the next slide to see what I think, in my personal opinion, are the best stocks in those three industries, sub-industries. So on this slide, we're looking at what I believe are the best stocks to buy in those three positively rated sub-industries of the communication sectors. So if I were to employ a sector rotation, or if I wanted to add extra sector exposure, I should say, to a portfolio in the communication sectors, I would think about buying these four stocks. So electronic arts is in the interactive home entertainment sub-industry. So in that sub-industry, I thought EA is the best. And Alphabet is my favorite in the interactive media and services sub-industry. And here, by the way, I've got the quality grades over here. And then I would choose between either Disney or Netflix in the movies and entertainment sub-industry. I would probably lean toward Netflix if I only want to invest in one of them, but I see no problem with investing in both. So that's it for now. In the comments, let me know if you have any questions. Also, let me know what portfolios or investment strategies you would like to see more of, or if there's a particular sector you would like to look at next time in addition to the communication sector, let me know. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com. We're now on Substack, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of dividend stocks we'll have purchased on Monday for our 2 dividend strategies. See ya!